This is Kim Willis again, cashflowprograms.com. Now, a lot of people have an interest in creating positive cash flow from residential real estate. And they also have an interest more specifically in the types of deals that we put together. And we work with rent-buy type strategies. We help people into their own home. At some point in the future, those people who are living in your house now, maybe they're paying you hundreds of dollars a month above market rent, those people are going to qualify for a mortgage, for a home loan. And when that happens, they're going to settle up the transaction with you and they're going to take over title to the property. That's great. Now, in the meantime, what's been the benefit for you? Well, the first benefit obviously is that you're creating positive cash flow. And let's say it was $400 or $500 or $600 per month over a 3-year period. That means that you're going to be enjoying maybe about $20,000 of positive cash flow over that period. In addition to that, there'll be a wash-up capital profit. And that capital profit may be $20,000, $25,000. Why? Because we mark up the property based on what we paid for the property, and then we add the markup, and then that becomes the price that the tenant will pay. So we've got that contract profit built in there as well. So these deals can be very nice. You receive drip cash flow on the way through, and then you receive a bucket of cash at the end. Of course, your tenant, he's happy because he or she has received the ability to own their own home. They've created some equity, they've been given a fixed price, they've got security of tenure, they've got the freedom to decorate the property and make improvements to the property. They'll certainly, as a rule, look after the property better than a traditional tenancy situation. So it's all good. It's what we call the win-win, and that's what we're always looking for. We're looking for positive outcomes for both sides. Now, people say, well, this is all very good, but what's the downside? Are there any downsides? Well, there are a few downsides, and look, the main one is to do with defaults. If you have the wrong person in your property, in other words, you haven't vetted them properly, you haven't done proper due diligence on those people, they may get into problems. Because keep in mind that they're not just paying market rent, they're paying an amount of money each week to you above market rent. That's a fact. And that's how you create your positive cash flow. So if they're paying, let's say, $550 a week and the market rent's $350 a week, so they're paying you a $200 a week premium, we have to be sure that those people are going to be able to afford that payment week in, week out. Makes sense, doesn't it? So we need to vet the people, and certainly we've developed lots of different techniques to vet people, and we can teach you those techniques. But we find that if we do a credit check, we get 6 months bank statements, employer check, we get pay slips, all of those sorts of things that a bank would ask for, well, then we can reduce the risks quite dramatically. And look, at the end of the day, if you've got the square peg in the square hole, you're probably going to have a very positive experience. They're going to have a positive experience. They're going to get what they want, which is their own home. You're going to get what you want, which is a cushion of cash flow coming in every month, plus a balloon payment at the end. So everyone is happy. So let's get it right from the outset. Main pitfall is to do with the people that are going to live in your house. If you get it wrong, that's a pitfall. If you get it right, there's only really upside, isn't there? So I just wanted to share that little point with you because lots of people ask about it. This is Kim Willis, cashflowprograms.com. Catch up with me on the next video. Bye for now.